everybody, Joseph Gozlan with Eureka Business Group. Today we're talking about part 4 of our multifamily financing series. In part 1 we talked about local bank loans. In part 2 we talked about agency debt. Part 3 was about bridge loans and CMBS loans. And today we're going to talk about the other kinds of loans, the special loans. So the things we're going to cover today are going to be private money, hard money, life insurance companies, and seller financing. So let's start going through those because knowing all your options is very critical for your success in investing in multifamily. So we'll start from the obvious one, hard money loan. Everybody heard about that. Usually it's a private lender that's going to give you money. It's going to be high interest rate, short time period. They're willing to take higher risk. They'll go to higher LTVs. They'll fund the rehab and so on. I would highly recommend be very, very careful when choosing hard money loan for your multifamily property, just because of the volumes of money we're talking about. If you're getting interest rate on $100,000 because you're doing a small flip, that's one thing. When you're buying a $4 million property, yes, there are hard money lenders out there that will lend you $4 million hard money, but that interest rate is going to be very, very painful. So it is an option. Be careful when to use it at the right opportunity, at the right time, and not just out of desperation because you couldn't get any other kind of lending. That eases us to private money and private money lenders. That is just like hard money, only more reasonable costs, more reasonable terms. So you can find a high net worth individual and structure them into the deal in a way that they are debt partners and not equity partners. As a debt partner, they get a guaranteed return versus a piece of the equity that is, come take the risk with me and you'll get the rewards with me, right? So you can structure your partners as debt partners. That would be your private money lending. The rates these days that I've seen around go anywhere between 6 and 8%. And that would really help you out with not being too worried about your carrying costs. And that is very important when you go through the rehab process and you're turning the property around, being able to kind of have that ease of mind that the interest rate is not going to kill you in that process. So that was hard money and private money. These are always options. These options exist in the residential world as well, and they transfer to the multifamily. Usually I've seen them used in the smaller properties, the 5, 8, 10, 20 units. I've yet seen somebody that goes in with a hard money lender on a $20 million deal, even though I'm sure there is someone that is willing to take that risk out there. Moving on, there is one more interesting type of loan out there, and that is life insurance companies. These guys are interested in long-term holds and long-term loans, and they're going to be very aggressive with the terms. I've seen them really competitive, even to the point where they will beat agency debt sometimes, depending on the company and the location of the property and the operator and the appetite for loan at that point in time. But when they have money coming in from life insurance people that insure themselves, then they need to deploy that money and earn interest rate on it so they can be able to do the payouts down the road for whoever needs the life insurance payout. So one of the things that they do is they invest in all these kind of things, in different assets, in stocks, in real estate, but they also generate loans because that is a guaranteed return versus a risk when they go into an investment position. So life insurance companies, a lot of the mortgage brokers out there will be able to offer you that option because a lot of them have the connections with the life insurance companies. Make sure you ask your mortgage broker if he has that relationship and if it's a viable option for your property when you're looking at a loan option. The last thing I wanted to talk about in the special loans segment is the seller financing. This has always been the holy grail for everybody in real estate. I don't have to deal with bank. I can only deal with one person and so on. There are a few things that need to happen in order for you to be able to get a seller financing on the property. I've seen a lot of people that ask, well, can I get seller financing? The answer is it depends. First of all, the seller has to have a lot of equity in the property. If the seller has 80% mortgage, there's nothing to finance. He cannot finance for you. He needs to pay off the loan when he makes the sale. On the other side, if the seller has 80% equity in the property and his loan is very low because he's been paying it down for a long time, or he bought it cash, then he has a lot of equity in the deal that allows him to do seller financing. In a seller financing position, basically the seller becomes your bank. He's going to be the mortgage holder and he's going to be collecting the interest rate from you. You're going to be having to report to him just like you would to any other bank, and he'll issue a 1098 at the end of the year. It's just a regular loan. A few caveats is for you to make sure that you know the seller, you understand what their goals are, because if his goal is to give you seller financing for 2 years and then he's going to need the money, then you better prepare yourself. And if he's looking for a long term and you're looking for a flip, that conversation has to happen just so everybody will be on the same page, because he's going to be your bank. You want to have a good relationship with your bank, right? Just like you would with normal bank. And yes, they can foreclose on you just like a bank would. So if you don't pay, they will foreclose and they will take the property back from you. So that's really where it is. How to structure a seller financing deal. You need obviously a lawyer to draw all the notes and all the loan documents for you. And I've seen people structure it with as little as 5% down. I've seen people structure it with 50% down. I've seen all kind of terms in terms of I'll give you interest only, or I will not give you interest only. I want extra payments to the principal every quarter. We've seen a lot of things. The only limitation on seller financing is the imagination of you and the seller, and trying to figure out what works for both of you and what's good for both of you in the long term. That's it with part 4. Like I said, we had 4 parts for the multifamily financing just because there's a lot of options and I didn't want to create a full hour worth of a video. So if you have any other questions, if there's any other kind of loans you want us to cover or comment about, please leave a note on underneath the video and let us know what you think. If there's any other subject you want us to cover, please leave a note as well. My name is Joseph Gozlan. I'm with Eureka Business Group. Our website is ebgtexas.com. Thank you.